Hi, my name is Dumisani Komo. I'm here to take you through dividend policy decisions. So this is going to be a four-part video. We're going to look at it in four parts. So this is part number 1 of 4. So you always hear about companies paying dividends to their shareholders. What do we mean by dividend? Those are the things that we want to discuss and look at. At the end of the video, we should be able to have an understanding of what a dividend is and how it fits into the organization's operations. And if you look at it, we are starting off from a company that has a strategy and it's implementing its strategy. And as part of the organization's objectives, one of them would be to increase shareholder wealth through making money by provision of goods and services that the company offers. And we then want to look at the result, which is the dividend. So by the end of this four-part video, we should be able to have achieved all of these objectives. We want to be able to contrast the active, variable, and passive residual approaches to managing dividends. These are theory-related issues. We want also to be able to explain the effects of paying a dividend on the dividend growth model, which is a topic that we can link to our capital structure and weighted average cost of capital. We also want to be able to determine a dividend by applying the residual approach. So in other words, we want to have an understanding of what the residual approach is all about. And we should be able to identify factors that affect the dividend decision. And remember, this is a decision that the directors need to make. So we need to have solid evidence about things that are going to affect our decision. And we should be able also to identify alternative dividend payout policies. So this is just talking about not looking at dividends in the form of cash only. There could be other dividends that we can pay out in the form of. And we also want to be able to list some important dates in the declaration and payment of dividends. And I think this we can also link it to auditing in relation to generating audit evidence in relation to a dividend that was paid. And we also need to be able to explain alternative methods of making distributions to shareholders and describe why share buybacks occur as an alternative to dividends, and lastly explain how dividend reinvestment plan work. So remember, as you are a financial manager, all your work revolves around 3 key decisions. The first one is a financing decision, which involves issues to do with how am I going to fund my operations. So assuming that you have obtained funding either in the form of equity or debt, where debt we're talking about preference shares, we're talking about debentures, loans, and other forms of debt. When you've obtained the financing, you're now saying, what should I invest in? Is this investment decision appropriate or not? And lastly, you then want to say, I've made some money out of the investment that I've made. So how am I going to pay back to my funders or to my providers of finance? And the key question in that case would be, if I am to pay a dividend using my existing earnings, what is going to be the impact on the shareholders and the share price of the company? So in other words, you are looking at a company that ordinarily pays dividends. So you're also asking yourself that have we not created an expectation on the part of the shareholders in the sense that regularly they now expect to get a dividend? Now, if you cut a dividend, how are the shareholders going to feel and how are they possibly going to react, especially taking into account things to do with changes in the environment in which we are operating our business? So we want to look at whether a dividend is relevant or not in relation to value of the company, or in other words, in relation to the share price of the company. So broadly, other people say a dividend is relevant and it has a direct impact on the share price of the company, whereas others think otherwise and they say the dividend is not relevant and doesn't have any impact on the value of the company. So we would want to look at this dividend and ask ourselves, is it an active variable? In other words, does it contribute significantly to the value of the share? Or it's just a passive residual, something that we are saying we can give to our shareholders after having taken all investment opportunities into account and allocating all the money that we have to those possible investment opportunities. So here there are two schools of thought. The first one takes the route of supporting the fact that a dividend is relevant to the value of the company and has to be managed very well and actively in order for us to have a change or an impact to the value of our company. Whereas the other school of thought argues and takes a different stance by saying a dividend has no effect on the value of a company and therefore it is irrelevant, and assumes that it just remains a balancing figure dependent on financing decisions. And we then also want to look at issues to do with taxation of these dividends. Should we pay a cash dividend to the shareholders, which triggers a dividend withholding tax, or should they sell off their shares after the shares have gained in value, which triggers capital gains tax? So can you see that we are jumping onto taxation? Earlier on, we had talked about auditing. So this topic can be interlinked with other subjects, or we can say with all the other three subjects that we learn. Now, looking at the dividend decision purely from a theoretical perspective, the first approach, which is the relevance supporting school, says does the dividend question, along with the investment and financing, affective value? Or we also want to ask ourselves, is the dividend merely a consequence of the other two decisions, which are our financing and the investment decision? So looking at the first school of thought, which supports the fact that a dividend is relevant, we are looking at it by dwelling much on the dividend growth model. So this assumes that the value of a company is dependent upon the future dividend payments of that particular company. So it therefore assumes that if we increase the value of the dividend, the value of the company is also expected to increase. But a counter argument quickly comes into play, because if you look at your dividend growth model, the numerator is the expected future dividend, whereas the denominator is the difference between your cost of equity and your constant growth. Whereas the constant growth rate is that portion of the company's earnings after having taken the dividend or after having deducted a dividend. So can you see that dividend is coming on both the numerator and the denominator? And therefore, a counter argument, therefore the dividend growth model assumes that if we are able to maintain a growth rate, a constant growth rate in our earnings, then it should be able to increase the value of the company, assuming that we are not increasing the dividend by the same magnitude that we are reducing our growth in our future growth. Therefore, the counter argument then would be, how is that really possible? Because if you look at it, our denominator is going to be deducted by the same growth rate that we had said our dividend is going to grow by. Therefore, this then triggers the other school of thought, which is the bird in hand theory. And this assumes or takes the position that a dividend has got a positive effect on value, which supports that a dividend is relevant to the value of a company. How does this school of thought support it? It supports its position by saying, if you give me a dividend today, it's worth more than just me expecting that I can sell off my shares in the future through uh, through capital growth. Therefore, it takes cash into account and wants to make sure and supports the fact that a person who has received cash actually is better off than someone who just expects that I have money, but it's in the form of shares, and therefore, if I sell it, I can then realize the money. But this could be also counter argued. And remember, we had been talking about increasing the numerator of the dividend in the form of expecting the dividend to grow, which has a positive effect on the value, but also by increasing the value of the dividend, it also have a negative impact on the future growth prospects of the company. Now, continuing with our dividend relevance and irrelevance discussion, we're now looking at the other side, which supports that a dividend is not relevant to the value of a company. And this is a proposition by Miller and Modigliani, who give their argument under some given assumptions. So the two say that if you pay a dividend, it reduces the growth potential of a company because the company was going to grow organically by taking the money that was earned as a profit and reinvesting it. And therefore, if the company pays out a dividend, it means that the future investment opportunities that are there will now be limited in terms of funding, which limits future dividend growth. And therefore, these two then argue that if you see a management team or the directors declaring a dividend, it's a sign of failure because they will not have taken all the investment opportunities into account. So they are supporting the fact that if shareholders want to gain in terms of, or if they want to make money, they should sell off their shares, and rather the company should not pay a cash dividend. And there are other companies that also take this approach. For example, those companies in the Silicon Valley, normally are technology companies, they do not pay dividends in the form of cash. They know or have confidence that the share prices of their companies are going to increase, and therefore they expect the shareholders to sell off their shares and make money out of it. And therefore, this approach is in synchrony with the residual approach, which also says that before paying a dividend, make sure that you have taken all investment opportunities into account and invest first before paying the dividend out to shareholders. And therefore, continuing with our Miller and Modigliani argument, these two then give reasons why they think that the dividend is irrelevant. They are saying if you pay a dividend today, you are going to fork out some money, and when you need the money now as a company, you're going to issue some new shares in the form probably of a rights issue to avoid dilution of control. But as you are doing so, you want to try to close the gap that was created by paying a dividend. So in other words, you're going to take again back the money that you had paid to the shareholders now in the form of capital. And in other words, they then argue that the shareholders are in the same position. But however, there will now be issues to do with dilution of value because of other costs that are associated with paying out a dividend and issuing new shares. Now, looking at the residual approach, this is just a proposition which says before a dividend is paid, we need to make sure that all positive return investment projects are embarked on, because it also supports that paying a dividend is a sign of failure by management. So there is need to have some criteria for qualifying a project or disqualifying it. So you need to make sure that whenever you are paying a dividend, it has to be something that is left over after satisfying all investment opportunities. So you need to have a portfolio of all possible investment opportunities and make sure that their required rate of return is above, say, the weighted average cost of capital, because that would be a positive return. And also you need to consider your targeted debt to equity ratio. Therefore, a company should accept all projects that have got a return that is above the weighted average cost of capital and invest in those projects first, because they expect that more value will be created by reinvesting the profits rather than paying out a dividend. And therefore, if there are any funds that are left after having satisfied all investment opportunities, then they can be paid out as dividend. So thank you very much for listening to the first part. We are then going to continue to part 2 of this same topic, dividend policy decisions.